Hello everyone, George DeSantis here with a look at the market for the week ending June 17th of 2016. Uh, Before we get into the charts, etc., and the market itself, and I should be doing this, let me just read a disclaimer here because after all, we're dealing with finances here. The disclaimer that we show here is trading and investing has large potential rewards and large potential risks. This video presentation is designed for educational purposes only and is not a solicitation or advice to buy or sell any securities or other tradable instruments. You must be aware of the risks and be willing to accept them in order to invest in the market. So consult a licensed professional investment advisor for investment advice. As most of you know, I started doing this look at the market for my own purposes and then started sharing it with others. But you need to do your own research and make your own investment decisions. Let's start by looking at some of the charts, the monthly chart of the S&P index. This is the monthly chart of the S&P 500. We always look at this first. If you're not sure about the triple screen approach, check out Alex Elder's book, Trading for a Living, or the New Trading for a Living, rather, in which he will explain the importance of using a triple screen approach. So on the monthly chart here, we have the parabolic still below the most recent bar. The chart doesn't move, of course, very quickly because it's a long-term chart. And right now, we need to know that the Kalman filter is crossed above the instantaneous trend line, and that indicates that the trend is up on this chart, on the monthly chart. MACD continues to trend up from below the zero line, and also Elder Force Index. We use a 13 period. It's really a 13-month period in this case. It's still above the zero line, so that is a good indication for the bulls anyway. It tells you that the market is trending up. Let's take a look at the weekly chart. And this is the weekly chart we often look at of the S&P 500. And as we can see very clearly here, we are still in this trading range from a little over 2100 to about 2050, 2046, that level. What happened last week is, well, the week before we had this shooting star, which is a trend reversal indicator, with candlesticks. And so we got this bearish candlestick here last week because we lost some momentum and price dropped a bit on the S&P, in fact quite a bit. However, we should note that the Kalman filter, the yellow line here, is still above the instantaneous trend line. So technically, insofar as the weekly chart is concerned, we are in an uptrend. Now, the question becomes: Are we going to continue to find support at 2046 or around there? Perhaps we'll see what we find on the daily charts. However, this is still holding. We came all the way down close to the 2050 level. We made a low last week of 2050.42, and then we closed a little higher than that. So the market is still trading in that trading range, and we have to respect the fact that until we break out of that range, we're going to have this carousel, highs and lows and highs and lows, but we keep going between those two levels. Let's take a look at the daily chart. This is one of the daily charts we look at on the S&P 500. And the first thing we should note, this is the 930 chart, the 9 exponential moving average, and the 30 weighted moving average, and the 90 weighted moving average. So at this point, what we can see here, as we saw before on the weekly chart, we're in this trading range between 2120 or so and 2046. We had an attempt to break below here, but we didn't. We came back up and closed higher, and just on Thursday. And on Friday, we had this small body candlestick here closing that was really part of a harami. We can argue that that's part of an harami, a bullish harami. So the bottom line is, we'll see if this 2046 level here continues to hold as support. If not, there's more to the downside, and we'll we can't anticipate that right now, but we have to keep our eyes open for that. Now, the RSI 12 crossed below 50%. So that's indicating that the trend is down, as we saw here, where the 9 EMA crossed below the 30 weighted moving average, and this also crossed below 50%, and that tells us that this trend here is at risk. We haven't crossed below 40, but we'll find that out pretty soon if we get there. Williams Pro Buying Indicator is now sitting close to actually just below the zero line. And likewise, percent hour just below the 50% line. So we're at a critical juncture here. We want to see if this market is going to go further down, of course. If we break below that 2046 support level, again, we'll determine that as time goes on. Let's take a look at something else. And here's the other daily chart that we look at on the S&P. And of course, the configuration is the same. We're looking at the same daily chart. So the price bars are the same. But what we want to note here is that Jerry Appel's sum of the rate of change indicator broke here as well, broke below the 4% line. So that doesn't look well for the bulls at all. The market here on the daily chart is in a downtrend. How far down? Questionable. We don't know. We hope we find support there at 2046. MACD is now trending below the zero line. Again, there's showing that weakness. There's a weakness to this short-term trend, the shorter term, the daily chart. And likewise, percent R is just hovering around the zero line here. So we wait to see, are we going to go any further down, or this market's going to find support. So here's another chart we looked at last week. It's a weekly chart of the S&P 500, and the difference here is that we have the CCI, or Commodity Channel Index. And I just wanted to note we are still below we're still above the zero line, and the Commodity Channel Index usually changes the indication of the trend by crossing below the zero line, as you can see here and here, for example, over here. But once we are above the zero line, the market is usually in pretty good shape in terms of the uptrend. Let's take a look at something else. And here's a weekly chart of the Nasdaq Composite. The Nasdaq, as they say, usually leads the market. If that's true, the Nasdaq's looking a bit vulnerable here. We have a double top. Okay, 1, 2. We have a double top. We have the instantaneous trend line below the Kalman filter, so technically the trend is up. But in addition to that, we have the parabolic sitting just below the most recent bar. Should it hit the the next bar and switches to a downtrend, well, we'll get some confirmation about the direction of the trend. In this case, we can see that the instantaneous trend line trended up a bit here, and to me, we are locked into this again. This trading range, not only on the S&P, but here again on the Nasdaq, and we can see that. Now, if we look below, we can see RSI 12 just about at the 50% line. So depending on how far down below the 50% line it goes, we can determine a little more in terms of the direction of the trend. Below that, we have MACD. MACD made a lower low, even though Nasdaq made a similar high here. It's equal in length, equal in height, I think. And so looking at this chart is pretty vulnerable to more of a downtrend. Let's take a look at the daily chart. And here's the daily chart of the Nasdaq Composite. First thing that seems to stand out here is that the Kalman filter crossed below the instantaneous trend line, indicating that we are now in a downtrend on the Nasdaq daily chart, as we saw on the S&P. So right now, we are waiting to see how far this thing is going to go down. If we get down, we might find support down here at about 4,700. So we wait to see how that develops. MACD, of course, is also below the zero line. So that is indicating that that downtrend is increasing, is strengthening the downtrend. And also, we might say, well, the bears are getting stronger. MACD is trending down here. In addition, we find that the Jerry Appel's sum of the rate of change indicators signal the downtrend here also. So we're waiting to see where this market goes. Both the S&P and the Nasdaq are in downtrends on the daily chart, and just holding on the weekly charts to an uptrend. So we'll see how that develops as time goes on. Let's look at something else. Now we look at the stockcharts.com charts with the impulse indicator, the red, blue, and green lines. And what we can see here, first of all, the 9 EMA is still above the 30 weighted moving average, the green line versus the red line, and above the 50-day moving average here, 50 period, 50 week in this case, since it's a weekly chart. Now the bars are blue, so we can go long or short. Before I tell you what my thinking is on it, I will take a look at the daily chart. But let's look at MACD here. MACD is trending down a bit, still above the zero line, but percent R is still above the 20% line, and that's indicating the momentum is still pretty good. Now let's turn to the daily chart, and we'll compare those two. Now we see on the daily chart that we have a number of red bars. The red bars tell us that if, depending on our time frame and our objectives, when the bar is red, we shouldn't be buying. Okay, we should not be buying this stock or this index when the bar is red. Well, MACD is below the zero line, so the bears rather are more in charge here. And percent R on the daily chart is just hitting the 50% line. So the daily chart obviously is a shorter term and it's more vulnerable. But one thing to note is that the 9 EMA is still above both the weighted moving average, the 30 weighted moving average, and the 50-day average here. So again, we are at this critical level. As far as I'm concerned, I have about 4 or 5 stocks under SSO. I haven't sold anything yet, because if the weekly chart changes to a red bar, I will definitely look to sell, as long as other indicators on my charts are suggesting that I do the same. So I'm staying put, haven't really sold anything, and we look forward to seeing what happens this week. Have a nice weekend, and we'll talk again next week about this difficult market.